Eric Henderson, 7 out of 10 people turning 65 are going to need long-term care insurance, but only 1 in 10 has an idea how to pay for it. So where's the disconnect?
I think the biggest disconnect is, people don't like the use it or lose it thought of long-term care. I mean, they know that maybe they might need it, but they think they're going to be healthy. But the idea of paying that amount of money and never using it just really turns a lot of people off.
All right, what about Medicaid and Medicare and Obamacare? How much will they cover if and when people need it?
Nationwide just did a study, and 7 out of 10 affluent Americans believe that Obamacare is going to cover the cost of long-term care, but it won't cover all the costs. Right? Medicaid is only going to cover if you have countable assets of less than $2,000, and Medicare is only going to cover up to 100 days a portion of your long-term care costs. So that's not the solution either.
All right, so give me the solution, because I know Nationwide has been rolling out some new products, some insurance with variable annuities wrapped in them. Explain how these work.
Well, I think one of the things that we've done is on the life insurance side, we've added long-term care riders to the policy. And the way that works is in the event of a long-term care situation, the death benefit gets accelerated so you can take those death benefit dollars and use them today if you need long-term care. We have other policies that actually do that and even pay additional long-term care costs beside that. So you don't have the use it or lose it feature you do with traditional long-term care.
Right, and I mentioned that there's an annuity stuffed in there somewhere. When you hear the word annuity, it scares a lot of people because of costs. Can you talk about how much these cost?
From an annuity standpoint, people are looking for ways to save for retirement, and we just added a feature to those products that basically in a terminal illness situation, you can accelerate the cost, accelerate your death benefit to pay for terminal illness costs, and we've done that for no additional cost. On the life insurance side, it's going to cost, life insurance with a long-term care rider will cost more than traditional long-term care, but it should because you're getting both the long-term care value and the life value.
What about kids paying for their parents' long-term care? Because a lot of kids, they have to pay for their kids, their schooling and their college, and they also have to worry about their parents.
That's really interesting. We found that exact same thing, and Nationwide just launched a couple weeks ago a new product that we call the Parent Rider. And what it does is this acceleration of death benefit like we talked about with life insurance, but it's on 2 people instead of on 1. So basically you can have both yourself, for example, and your parent be both insured on the life policy. It's a second to die policy, but from a long-term care perspective, if your parent has long-term care costs, it pays for that. If you have, it pays for that. If it both has, it pays for that. So a lot of folks are thinking, hey, I have to take care of my kids and I have to take care of my aging parents. I'm going to have to come up with those expenses anyway. With this policy, basically, if your parent has those costs, you can accelerate the death benefit to pay for that. If they don't, you still get the full amount of death benefit when you pass for your children.
All right, well, thanks a lot for coming here to talk about it, Eric Henderson.
Right, thank you, appreciate it.
Thank you for watching The Street.